Well, I think they should stop hiking Fed funds rate before we break something. We're pretty close to that point now. And I think they need to, try and articulate to the public and the policymakers what we can expect going forward. There was a fascinating letter from the mortgage bankers and the home builders and the realtors a couple of weeks ago that said, can you give us some guidance? Because the guidance the Fed gave us before about transitory inflation was clearly wrong. And a lot of companies use that guidance in planning their business. So I think the Fed has to be very careful what they say in the future about inflation and other benchmarks because people sometimes take them at face value.
Well, but they've been saying for a couple of years that they're going to hike rates like we never
Yes.
seen it before to try and quash inflation. I mean, they've been telling everyone in the market hasn't believed them, for 2 years
Right.
almost.
But they've caused a lot of inflation, though. Look at housing. We're not going to take that back easily. We're going to deflate housing 20, 30%. No, we're not going to do that because they know that there's a deflationary aspect out there still, and it's called bad debt. When debts go bad, that's when you get deflation. So I think the Fed is, as Craig Torres was saying this morning, they're in risk management mode now because I think they know they can't go any higher without really seriously causing something to break in the world of credit.
Where do you think, by the way, we're going to see debt go bad? We've been talking all morning with people about high yield, and
Right.
no one is concerned. Spreads are relatively tight. And
Mm-hmm.
the answer they tell us is that all these companies, were so much smarter than Janet Yellen. They got all their financing under control when rates were zero, and they're
Right.
in a great situation now. But it seems hard to believe.
Well, they're getting the financing done, not necessarily on advantageous terms. They're doing a lot of discount issues, for example, to keep the coupon down, but you issue the bonds at 8. Now, when the bonds get redeemed, that's going to hurt. So I think there's a lot of ways people are adjusting to this. But, to be honest, you see the carnage now in commercial real estate. I think every day you see a headline crossing the screen in commercial, and what you don't see is the other 5 events that are private, and you won't see them until they hit the courts. So believe me, there's a lot of destruction going on right now on the commercial side, and it's the opposite of 2008. It's the way I would put it to you. This is not consumer, and you're not seeing it yet in consumer-facing vehicles like fintech and that sort of thing yet.
So
But
you think?
as this reprices, you'll see more.
Yeah, I want to. That kind of goes. So you think we'll see it? I guess one of the areas you think we'll see a break will be in commercial real estate. Is that? Do I understand that right?
Oh
Seen
yeah,
it.
yeah.
Yeah.
It's happening now. I mean,
Okay.
look at it this way: most banks have 50 cents worth of equity in commercial loans. Okay, so that means they'll wipe out the quote unquote owner, and then they'll end up owning the asset at 50 cents on the dollar. Now, even then, though, they may not be able to sell it because in a rising rate environment, it's hard to sell assets, and it's hard to sell dead banks. Usually, when the FDIC is taking care of dead banks, the Fed's already dropped interest rates. So there's a kind of a synchronization problem right now.
Yep.
The Fed is trying to address inflation, but we still don't have a recession. I mean, home prices in New York State are still going up, for Christ's sake. We're the weakest state in the U.S. before COVID in
So,
terms of pricing.
do you expect some big financial names to come under pressure? They're already sitting on hold to maturity portfolios that are,
Yeah.
are worth far less than they'd like us to know. And commercial real estate, we thought was the next shoe to drop. Now it looks like it's falling. Who's going to get hurt?
It's an earnings problem, Matthew, more than a systemic problem. I don't think the Fed will let it get that far. But the inflationary implications of, say, another bank failure are huge. Because if I can't find another bank to buy the dead bank, I have to liquefy the whole thing, which is why the Fed had to lend the FDIC $200 billion. So, I think that if we see another problem in the credit markets of size, the Fed's going to have to retreat almost immediately. I think that'd be good for a point on Fed funds because you can't deal with problems of credit unless rates have already essentially conceded. You know what I mean?
Yeah.
If people think rates are going up, How do I sell those assets? Even at a discount. FDIC will normally give you a 30% discount to create new equity under the asset. But even then, you might have a hard time getting buyers in this environment. So the funny part is, to your point, is there's people out creating and buying assets today at really crazy prices because there's cash on the sidelines. There's a huge amount of cash on the sidelines. And what they're waiting for is a signal that we're done, a real signal.
Yep. We're done raising rates. And it seems like the market feels that way right now. The question is, what happens with the economy, in Q4 in 2024, and then does the Fed have to cut rates? And not by 50 basis points, but maybe more.
I think they're going to try and keep rates more or less where they are because they realize that volatility has not been helpful for a lot of businesses. And I think they also realize that housing particularly is going to get absolutely crunched in the next 12 months. We're going to take another third of capacity out of residential mortgage lending. And you're also going to see capacity coming out of commercial too, because there's not much volumes. I sit with the loan production team in Cohen in New York. They're not busy right now. And the reason is that the buy-side investors, who typically are the cash buyers for commercial loans, hotel loans, that kind of thing, they're on the sidelines too. They're trying to figure out where price and where value is today. And most of them have already filled up their allocations for this year. So they're happy to go into the end of the year flat. That's not helpful to people who need to do deals. You know what I mean?
Yep.
So
what is going to happen, Chris, to those markets? I mean,
lower volumes.
No one's going to want to sell. Price. No one's going to want to sell a commercial building if they don't have to at a 60% haircut. Nobody wants to sell a residential home, right? Because you're not going to remortgage to get someplace else at 8% when you're in at 3%.
Well,
so
resi's different though.
Yeah.
You remember commercial for the last 75 years, the assumption has been that the asset would go up in price and we could just do interest only. And that was very much the style in the commercial real estate business. Now you can't, because when the lender comes to you, if the rent roll is down, the building is worth less. They want equity. You've got to put more cash in to roll the mortgage. That's the difference in the dynamic today. And as the treasury deficit goes up, guess what? The Fed has to hold more cash. And what do they do with that cash, Matthew? They collateralize it with treasury bonds, for Christ's sake. Makes no sense. So
it makes sense to Sam Bankman-Fried. He would get that. It sounds like something FTX would have done.
But listen, they're raising rates already, and we're going to make collateral more dear at a time when we're producing nothing on the mortgage side, by the way. We'll do $1.5 trillion this year in new coupons. And treasury issuance will be big. But still, and they're going to be buying back low coupon bonds too while we're doing all the rest of this stuff. That's going to be interesting.